Hey everyone, and thanks for jumping back into the cryptoverse. Today we're going to talk about risk management with Ethereum. It's been a while since we talked about the risk metric for Ethereum. So if you guys like the content, please go ahead and subscribe to the channel. Give the video a thumbs up and let me know what you guys think about it in the comment section below. We also do have a public Telegram channel, over 4,300 people. You can go check that out and discuss this chart amongst other charts and your general thoughts on the market. And then finally, we have the premium list at intothecryptoverse.com, where you'll find access to this type of content and the risk levels. So what this is it's a risk metric that just simply goes from 0 to 1, and we look at past volatility of Ethereum, and we try to identify, when our historic risk levels are, advertising a sell signal, and when they're advertising, say, a buy signal. So if it's close to 0, it means it's historically a great time to buy. If it's, say, dark red, then it's historically a good time to sell. And so you have these, discrete levels, which you could consider different risks of Ethereum, of purchasing Ethereum, or, say, selling Ethereum. And the goal, in a perfect world, is to, minimize the risk exposure you have when you're buying Ethereum, and to maximize the risk at which you're selling it. You want to sell it at the higher risk levels. You want to time these moves, these more volatile moves, rather than, say, selling everything in a region like this, okay, like where it's down here and it has a potential large or a large move that it could take. So how do you do this? This is the question. How do you do this? And if you've seen the channel before, you know that, well, we do it dynamically, and this is the risk chart. Price on the primary y-axis, it's on a logarithmic scale, meaning this is $10, $100, $1,000, and then the risk is the color code is removed and it's just put on the secondary y-axis, and it's the orange curve. So the orange curve corresponds to this right axis, the secondary y-axis, and the white line corresponds to the primary y-axis, which is the price. All right, so you can see the risk. It starts off around 0.5 or so back when it first launched, and it came down here up to around 0.1, back down to below 0.5, back up to between 0.7 and 0.8, and then all the way back down here, and then it's been just chugging along. Well, what do we say? How can you make sense of this in a way that it allows you to accumulate more effectively and recognize when Ethereum has moved so much recently that if you just look at historical data, not what Ben thinks, but you just look at historical data, you say, oh, well, in the past when we made these types of moves, then we recognize that, the risk was a lot higher, and then there was, an increasing likelihood that we were going to see a retracement. So you basically buy Ethereum. This is what I do. You buy Ethereum in these, certain risk levels. So you could buy, starting at the 0 to 0.1 risk band and all the way up. You could buy all the way up to 0.9 if you wanted to, but what I tend to do is, around 0.5 for Ethereum. And honestly, I mean, the amount I'm buying in this region is so much smaller than when I'm buying down in these levels that it's I wouldn't say it's negligible, but it's just it's such a smaller position. Well, how do you manage that? How do you if you're buying up here and you're putting in, say, $500 a month or $500 a week or $10,000 a week, whatever it is, if you're buying it up here, you're getting less Ethereum, than if you were, say, buying it at a lower price. Okay, this is the idea. But the point is, what if you do it dynamically? So you figure out what your X is, and X is, your base investment. So let's say your X is, say, $200. Well, that means when the risk is between 0.4 and 0.5, you DCA $200 into Ethereum. When the risk is between 0.3 and 0.4, you DCA 2x, so 2 times $200, so $400 into Ethereum. When it's down here, $600, and you just do it on a regular schedule. You don't try to time the market because it's a really difficult task to do. We're not day traders here. We look at these macro level momentum shifts in the market, and we just try to time, if we're putting in a lot, like in regions back in December of 2018, or maybe now, if you're still accumulating Ethereum at these risk levels, you're putting in a lot less. And the reason why you do this is because it reduces, your cost basis, of course, for acquiring Ethereum, but it reduces your weighted risk. If you calculated your weighted risk for accumulating all of this Ethereum, it'd be nice if your average entry corresponded to, say, a risk level between 0.2 and 0.3. If you find yourself with an average entry between 0.4 and 0.5 on, say, every asset across the board, what it likely means is that you're the dumb money and you're selling it when you shouldn't be selling it, and you're buying it in a region where it's really iffy if you should be buying it. So you need to change this mindset. And it's hard to, right? It's hard to go against what the masses are saying when they're saying sell, sell, sell. They're saying it's going to go down to, say, $50, and you get that fear and you don't want to do it. Well, when Ethereum is dropping, like this, and it's at these levels, you have to consider that most of the money is made by the people that are acting, contrary to what the vast majority of the people are doing. They're buying at this region over here, so that by the time it gets over here, they're already up 2 or 3x, not up 50% because they bought last week. This is the idea. So you dynamically DCA into the market like this, and then you can dynamically DCA out, because the point of crypto is we want to really maximize our returns. Any investment, right? So you don't want to necessarily sell. Let's say the 0.5 to 0.6 risk band is where you sell. If this line were to get up into this region, if this is, say, where you sell, you don't want to necessarily go sell like your entire stack or maybe 50%. You want to retain a lot of that, so that if the price continues to move up like it has in the past, you still have more that you can sell. On the other hand, if you sell a small amount, then it gives you the opportunity to say, you know what, I took a small amount of profits, I put it into some other asset, and if the price continues to go up, I'm going to continue to dynamically dollar cost average my sells, so that if it reaches this highest risk level, then I would be selling 5Y at that risk level. Now you might be wondering what Y is. Well, the idea is if you just add these up, Y, 2Y, 3Y, 4Y, and 5Y, and you set it equal to the total number of Ethereum that you've accumulated, then you know that Y equals the total number of ETH divided by 15. Therefore, if you had, say, 100 Ethereum by the time you got into this risk band, then you would, this would mean selling 6.67 Ether between 0.5 and 0.6, 13.33 between 0.6 and 0.7, and then so on and so forth up to the top risk level, where you'd be selling, say, a third of your entire Ethereum position that you had when we entered this level, between the 0.9 and 1 risk band. Now, the thing is you might think, well, why would I want to do this when I could just not sell any of it and just sell it all up here? Well, first of all, we don't know if it'll ever make it up here again. In fact, as I've often said for a lot of these coins, the one I made for Bitcoin accounts for diminishing returns and lengthening cycles. The one for Ethereum does not, and it's just because it's only been through one market cycle. I have projections as to how I think it would play out, but I don't want to use Ben's projections as to creating a metric that is people are going to make decisions on. So I only use the data for that asset to make the risk metric for that asset. Because of that, I don't actually have a way, I'm not actually projecting diminishing returns. And since we know that the macro level volatility of the cryptocurrency asset class as a whole is decreasing, including Ethereum, I don't expect the risk, this orange line, to ever make it back to 0.9. So you could consider, that 0.9 is kind of like our upper bound in a sense. And again, it's possible that we go above 0.9. You also have to remember that this is just fit to daily data, not hourly data. So it's obviously possible we could wick up and it reaches that level. But I wouldn't expect to spend a significant amount of time in this risk level, even at the peak of the bull market. Again, it's possible. I just don't think that we're going to see the same type of volatility that we saw in the last market cycle. Therefore, you'd have to take that into consideration, and you might even consider shifting these down and selling, having your first sell zone be within the 0.4 to 0.5 risk regime. This is a possibility, and it obviously depends on your risk tolerance. If you're really averse to risk, then you're probably not going to be buying Ethereum when it's just moved up from 235 to 305 in 6 days. You're probably not. Now, what if you wanted to take on a little less risk? Okay. Instead, you could start selling here, right? At 0.4 to 0.5, you start selling here, and then you have Y, 2Y, 3Y, 4Y, 5Y, and 6Y. Therefore, your Y would be the total number of Ethereum you have divided by 21. And you could even, if you wanted to, you could ignore the 6y and keep it as 15 and just assume that you're going to be maxing out at this risk level. But we'll see. You could just play that. See how it goes for now, and just see what you end up with. I mean, for me right now, I'm essentially operating on more of, say, the Ethereum Bitcoin risk metric than the Ethereum USD risk metric, because I am looking to move back and forth and to slowly accumulate my position. Now, one of the things you have to consider too, if you buy and hold, which obviously has benefits, it might reduce the amount of taxes you owe. Maybe you're avoiding short-term capital gains taxes, etc. But what it does not allow you to do is it does not allow you to accumulate more Ethereum by not investing more money. So the nice thing about, say, selling, let's say the risk of Ethereum pops up into this risk band up here. If it pops up into this risk level and you sell, say, 6.67 Ether, and then it comes back down into your buy region, well, you can take the profits and then rebuy, and then voila. I mean, you've accumulated more Ethereum, and you really haven't risked a whole lot to do so. All you did was you sold a small amount of your position to ensure that you're taking profits, and you bought it back when it dropped. And again, if it doesn't drop, it doesn't mean that you made a bad decision. It just means that you can continue just marching on up the curve until you've sold all your Ethereum. Now, why does this become important? Well, I have this risk metric for a lot of different assets now. We have Bitcoin, Ethereum, Chainlink, Cardano, Litecoin, and a few others. We're putting more on there. So the idea is you just look at the market as a whole. You look to see, okay, well, the risk level of this coin is at this level. Maybe I want to buy some of that. But I say that this other one is at 0.8. I probably want to DCA out of that asset a little bit. So it just allows you to quickly look at the market without having to follow every single move. Another thing that it's important to use the risk metric, for, in my opinion, is that you don't actually, a lot of people will let their emotions get in the way, and they'll think about, okay, well, what has Ethereum done in the last week, and that's how I define my risk. This takes into account data from more than a week, a lot longer than a week, and you can use that information that you might not intuitively feel into managing our position. I mean, this is not financial advice. This is just how I personally deal with these markets, and it's just the idea of you accumulate down here when the market is boring and no one wants to talk about crypto, and the longer period that we have down here, the more euphoric you're going to fill up here because you had those boring times. And when people 3 or 4 years from now say you were so lucky, you were not lucky again. It was a calculated risk that you took at a time when the market was not in general support of purchasing Ethereum, but you did it despite what the market thought. So this is the general idea. Now, to take on, let's say you wanted to limit your short-term capital gains and you don't want to be buying and selling. You don't want to buy here, sell here, buy here, sell here, because you just don't want to have to worry about the tax implications on that. One thing you could do to limit short-term capital gains taxes is to say only buy in, say, the lower risk levels down here, and then only sell way up here. Therefore, you just buy down here, you buy Ethereum when it's in these lower risk levels, and then you sell it up here, and you just don't care what the market does in between. Here, for instance, it would have allowed you to pick up a little bit more. It went up, you did nothing. You came back down, you bought a little bit more. It went up, you're not doing anything, and then maybe if it comes up to this level, then you'll sell. Now, why is this important? Well, a lot of people have a hard time dealing with this because they can't not continue to put money into the market. And the reason why something like this could be important is, and take a seat if you're not taking a seat, there are other asset classes besides crypto. I'll say that again. There are other asset classes besides crypto. Therefore, if you have a finite amount of resources, a finite amount of money to put into the market, and you're wanting to get in at the lower risk levels, then you say, you know what, I'm going to look at these 4 asset classes I'm investing in. I'm going to look at traditional markets like equities. I'm going to look at precious metals. I'm going to look at crypto. I'm going to look at real estate, maybe commodities. And I'm going to say, you know what? I see that this quarter or this month that the risk level for Bitcoin and Ethereum has dropped significantly, or we've dipped back in. I'm going to pick a little bit up. Or when the risk is at 0.6, you say, you know what? The risk is too high for my taste. But look, it looks like this stock that I like to invest in, it looks like it has gone down recently. Maybe I'll put the money there. And this diversification is how you continue to grow your wealth without just putting everything into one asset and making your idiosyncratic risk exposure to one asset just shoot through the roof. Because you don't want your entire net worth, say, in Ethereum, because if it drops by 50% tomorrow, again, you don't want your net worth to drop by 50%. This is the whole idea. Now, the Ethereum Bitcoin risk metric, I feel like, is even more insightful because you really can see it does have this upper volatility level that has been hit twice in 2016 and in 2017. We're still relatively low now. Now, you're probably wondering, how do you get access to this? As I've mentioned before, you can get access to all of this through the premium list at intothecryptoverse.com. You'll get access to the Google Sheets dashboard that has the live risk levels for Bitcoin, Ethereum, Chainlink, Cardano, Litecoin, and we're putting more on there. So do check it out. You also get access to a private Telegram alerts channel. I'll tell you what I'm doing. So you might wonder, well, what's Ben doing? I'll tell you what I'm doing, and I post what I'm doing in there. People seem to really like that. So you can check that out. You can follow along with what I'm doing if you want. If you don't want to do that, you can say, you know what, Ben doesn't know what he's talking about, but I think I'll trade contrary to what he's doing. You could do that too. I don't really care. But if you do want to know what I'm doing, you can check out my website, intothecryptoverse.com, and get access to the premium list. In addition to those two things, which I do think already provide a lot of value, you get access to a weekly premium video every single week, sometimes more than one a week, and then also a weekly report. And the weekly report is called the Quantitative Investor. We really dive deeper. You guys might think that we dive deep as it is on my channel. Well, check out the premium list because we even go deeper and we look at really ways that you can systematically improve how you can manage your position within cryptocurrency. So whether you're new to crypto and you just have no clue about it, I think it can appeal to you. Or if you've been in crypto for a long time and you just, you've accumulated a lot and you just want to capitalize on it during this market cycle, rather than just watch the top come and go again, then by dynamically DCAing in and out of the market, I think that it can help you accomplish this. So do check it out. You can pay with crypto for 6 or 12 months and get a 5 to 10% discount. Other than that, I do think it's taking worth. You can always sign up for it for a month. You can do it monthly, obviously, and if it's not your thing, you can cancel. But so far, we have over 400. I think we have 450 people on the premium list. I do think it's providing a lot of value. Let's finally just jump back into to Ethereum. We've posted a lot of videos. We said this is the accumulation phase of a lifetime at this fair valuation line, which we were at just a few days ago, and we said we're going to break down or break up, and if we break down, it'll be short-lived, which I do think it would have been if we had broken down. But guess what? We broke up, and the price now of Ethereum is 305. 6 days ago, the price was 235. So you can see how just getting into the market a week ahead of time can immensely change how much Ethereum you can accumulate, and therefore completely change your expected ROI at the peak of the market cycle, which I do think will be maybe 3 years from now. So we're getting close to the top of our primary regression line. If we were to pop out of this, I would start considering that we might be getting into speculative bubble territory, but you can see that we've been well into speculative bubble territory multiple times. So do consider that. We'll obviously follow that. This was one of those charts that I showed a while ago. I just drew these trend lines, not that they mean anything, but just to guide the eye as to, you can see this general downtrend here, and then the general uptrend that we've transitioned to. This is Ethereum versus Bitcoin. And the nice thing, right, is what did we talk about for months? We talked about this moving average, this 20-month moving average, and that every month that was where our wicks went to on the Ethereum Bitcoin valuation. We said once we break this, it really could be the sky's the limit, and we're really gonna see Ethereum break out of this undervaluation region. Sure enough, we broke past the 20-month moving average and just have shot up, and we've shot up into what I think will be our next accumulation region. Now, I don't, maybe we don't shoot above it and then come back down. It could just be that we slowly just build out an accumulation region in this area, but we'll obviously keep an eye on it. I mean, Ethereum has been moving significantly. Would not surprise me if we retraced. At the same time, it would not surprise me if we just made a run at $400 over the next month or so. So you just have to consider that no one knows what's going to happen in the short term. It's more of a random walk. attributable to geometric Brownian motion than any type of short-term technical analysis, in my opinion. I'm sure a lot of you would disagree. That's just my opinion, and I respect the fact that people have differing opinions, and I understand why you do. It's just not how I operate personally, because I find more value in looking at shifts in the market and moving in and out of assets slowly, rather than kind of going in the all-in approach, FOMOing into Ethereum when it's like $1,000 or something, and then just kind of seeing what happens. No, this is not investing, and that's called gambling. So let me know what you guys think. I mean, give the video a thumbs up, subscribe to the channel. If you like the risk analysis, you can get live access to it if you sign up for the premium list at intothecryptoverse.com, as well as the premium alerts channel. And then, of course, we'll continue posting videos on the public channel. We'll follow the Ethereum move and see, just how high we can go. So that'll wrap it up for this video. I hope you guys enjoyed the content. Make sure you subscribe, join the Telegram channel, and I'll see you next time. Bye.